In the realm of personal finance, one number holds significant sway over your financial life. If you found yourself puzzled by credit card or loan rejections, the root cause boils down to your credit score. As the saying goes, the credit score breaks up with the credit card because it cannot handle its emotional baggage. Joking la you, so serious for what? Welcome to What is the Matter, where I will be sharing with you on money matters. Today, let us explore on credit scores in Singapore. What is credit score? Your credit score is a number used by lenders to indicate how likely you are to repay your debts and default on them. Your credit score falls over a range of values. The higher your credit score, the lower your credit risk. Financial institutions, such as banks and licensed moneylenders, use credit scores to evaluate the credit worthiness of their consumers and as a risk management tool for lending money and extending credit. Let us look at the following table. Credit scores are generated by just two independent rating companies in Singapore. They will furnish this credit-related information about consumers to lenders. However, these rating companies have no say in determining credit or loan approval. It still entirely depends on the lender's risk tolerance and their policies. The Credit Bureau Singapore, CBS, provides banks and finance companies with consumers' credit scores, and the Moneylenders Credit Bureau, MLCB, provides them to licensed moneylenders. You can purchase your credit score report on the CBS or MLCB website. So why is credit score important? Having a good credit score is advantageous in getting approval for new credit cards, as well as personal, business, education, and housing loans. You might also be eligible for more favorable loan terms and interest rates. A lower credit score could pose challenges, potentially making it harder or disqualifying you from obtaining a credit card or loan. Even if approval is granted, the interest rate and terms could be less favorable and more restrictive. If you're looking to work in the finance industry, your future employer might also want to review your credit score. Next, Mr. Huat is going to let you know on what are the factors that affect your credit score. Your credit score is a culmination of your credit payment history and financial behavior, influenced by various underlying factors. 1. Utilization pattern. Your utilization pattern refers to how much available credit you are using. Higher utilization could mean that you are taking on more financial liabilities, posing a higher credit risk to lenders. This could reduce your credit score. 2. Account delinquency data. Having a history of late, partial, or missed payments on your credit cards or loans would mean that you are not responsible for repaying your debts on time. This could negatively affect your credit score. 3. Credit account history. Possessing a long track record of consistent, prompt, and full repayments would demonstrate your reliability of managing personal credit over time, which would improve your credit score. 4. Available credit. Too many open or active accounts available for credit, such as credit cards, loans, accounts with different banks, will affect your credit score. 5. Recent credit. Lenders will factor the timing and recentness of your credit activities when assessing your credit worthiness. Taking on multiple new credit accounts in a short period might be perceived as stretching yourself too thin, which could reduce your credit score. 6. Inquiry activity. When you apply for new credit, lenders will access your credit report. Multiple inquiries within a short period could give the impression that you are assuming more debt than you can manage, increasing your credit risk to lenders and negatively affecting your credit score. How to improve your credit score? Here's the good news if you've made mistakes in managing your credit and are looking to improve your credit score. Credit reports in Singapore capture your credit history over the past year. This implies that you can still boost your credit score by implementing good practices during this period. Good practices, my friend. 1. Make timely repayments. Always aim to pay on time. Frequent late repayments will definitely reduce your credit score. Avoiding default on your loan payments is also crucial, as it can have a lasting impact on your credit report and prevent you from securing future loans. It's always a good practice to pay your credit card bills fully every month so that the interest doesn't accumulate over time. If you're unable to settle the entire amount at once, prioritize paying the minimum before the billing cycle ends. At times, your finances might be crunched due to emergencies or unexpected situations, resulting in difficulty in repaying your loans on time. If you find yourself in this situation, you can always consult a credit counselor or seek alternative repayments through debt structuring with your bank or licensed moneylender. 2. Limit the number of loans and credit cards you apply for. Too many credit facilities will not only increase your inquiry activity, it could potentially signal overextension and higher perceived financial risk. Thus, it would be wise to close unused credit cards, restructure, and close unnecessary accounts to help you simplify your financial portfolio, save you from incurring unnecessary fees, and demonstrate responsible credit management. 3. Avoid taking on multiple credit facilities in a short period. Assuming multiple loans simultaneously implies undertaking higher debt obligations. This could suggest to lenders you are struggling with debt management, potentially portraying you as a borrower with an elevated level of credit risk and a lower credit score. You could instead consider staggering your loan or credit card applications with monthly intervals to avoid any adverse effects on your credit score. If you find Mr. What is the Matter contents useful, subscribe to my channel as I will be sharing with you more on financial literacy. What